Okey, Bismillahirrahmanirrahim. Selamat datang ke Bank Negara Malaysia. Pada sidang akhbar ini, pertumbuhan ekonomi negara serta perkembangan monetary dan kewangan pada suku yang kedua tahun 2015 akan diumumkan. Ekonomi negara mencatatkan pertumbuhan sebanyak 4.9% pada suku kedua. I'm very pleased to welcome all of you. This must be really the record turnout. Well, we hope we live up to your expectations. The expansion of global economic activity remained moderate in the second quarter, and while the US and UK economies continued to recover, improvements in the euro area and Japan were more modest. The Chinese economy sustained growth of 7% in the second quarter as targeted policy measures provided support to economic activity. In the region, growth was supported by domestic demand. The Malaysian economy registered a growth of 4.9% in the second quarter, with private sector demand remaining the key driver to growth during the quarter. On a seasonal adjusted quarter-on-quarter basis, the economy grew by 1.1%, and this is important. On the supply side, the major economic sectors continued to expand, but at a more moderate pace during the quarter. Following the lower growth in household spending, the services sector grew by 5% due to the moderation in most of the services subsectors. Meanwhile, the agriculture sector turned around to register a positive growth of 4.6% amid higher production of palm oil. Growth in the construction sector moderated to 5.6% due to slower activity in the residential, non-residential and civil engineering subsectors. The manufacturing sector recorded a moderate growth of 4.2%, attributed to more modest performance in export-oriented industries. The mining sector recorded a growth of 6% amid lower output of natural gas, and this was mainly because of maintenance work for oil and gas fields were carried out in the second quarter. Now, the private sector domestic demand remained the key driver of growth, expanding by 5.7% during the quarter. Private consumption expanded by 6.4%, while private investment grew by 3.9%, and private sector spending expanded by 0.9% during the quarter. This was mainly public consumption expanded at a higher rate of growth, reflecting stronger increase in both emoluments and supplies and services. Public investment, however, recorded a decline during the quarter following a decline in investments by the public enterprises and also the near completion of a few of the large projects in transportation, infrastructure, and resource-based manufacturing subsectors. The federal government spending on fixed assets remained positive during the quarter. Net exports recorded a negative growth of 10.5% during the quarter, due mainly to weaker exports and lower global demand. Compared to the strong growth of 8.8% in the first quarter, which lifted by front-loading of purchases prior to the implementation of the sales and services tax, that is the GST, private consumption growth moderated to 6.4%. I should mention that the average growth of consumption is 6.7%, so it's just marginally lower than the average long-term growth of consumption. And the moderation, we knew, of course, during the first quarter there was significant front-loading of consumption prior to the implementation of the GST, and so we have a 6.4% growth in the second quarter. However, we should note that during the quarter there was still wage growth and stable labor market conditions, and this remained supportive of overall consumer spending, which can be described as firm. And we should note, of course, that consumers benefited from the lower fuel prices. Private investment growth moderated to 3.9% during the quarter, and this is attributed to a decline in spending on machinery and equipment, especially in the transportation segment, as the total number of aircraft delivered in the second quarter was lower compared to the same period in 2014. And despite the slower pace of dwellings investment in structures remains supported by capital spending in the manufacturing and services sector, particularly in the export-oriented industries. The current account surplus in the balance of payments remained sizable at 7.6 billion ringgit, and this accounts for about 2.7% of GNI in the second quarter, supported by the continued surplus in the goods account and a lower deficit in the primary income account. The goods account continued to record a surplus, and the lower surplus was due to slower trade activity amid modest growth in global demand and continued weakness in the commodity prices. The primary income deficit was, however, lower due to higher income from direct investment abroad. Income on foreign direct investment was sustained, and this is important for a country like Malaysia. We have been the recipient of foreign direct investment for more than 100 years, and we have a steady inflow of such investments because Malaysia continues to be an important profit center for these investments. The deficit in the services account was, however, higher due to lower travel receipts, and the higher services deficit also reflects Malaysia's continued reliance on foreign services providers, particularly in the transportation and other services. As in June 2015, Malaysia's external debt remains manageable at 794.3 billion ringgit, equivalent to about $208.4 billion or 68% of GDP. And the rise in external debt in ringgit terms is partly due, of course, to the valuation effects of foreign currency denominated borrowing with the depreciation of our currency. Nevertheless, at this level of external debt, it remains manageable. The valuation effects are essentially contained as corporate borrowings are largely hedged. A significant share of these borrowings is intercompany loans with flexible and concessionary terms. The banking sector borrowings are partly covered by corresponding external assets. Excluding valuation, the higher external debt reflects the increase in the banking sector's external debt due largely to the centralization of their foreign currency liquidity management operations. Malaysia's external debt is skewed towards medium and long-term tenures, with the short-term external debt amounting to 43% of total debt, and as at June 2015, short-term external debt stood at 340.7 billion ringgit. It is manageable and has limited immediate claim on international reserves. This is because more than 2/3 of the short-term external debt is accounted by the banking sector, largely in the form of interbank borrowing and non-resident deposits. The debt liabilities are partially covered by the bank's corresponding external assets. So this accounts for more than 43%. And the bulk of other short-term debt liabilities reflect trade-related and direct investment activities. These are trade credits and are largely backed by export earnings, and intercompany loans are generally, as I've mentioned, flexible to their companies and on concessionary terms. Headline inflation was higher at 2.2% in the second quarter, and this was within our expectations as we priced in these increases. This was mainly due to the impact of the implementation of the goods and services tax, which replaced the sales and services tax. The price increases were broad-based, with all 12 categories of the CPI basket registering higher inflation in the second quarter. Meanwhile, core inflation remained stable. The lower global commodity prices have partially offset the impact from the weaker ringgit, and then inflation for Malaysia's trading partners also remained low, thereby contributing to lower imported inflation. The Monetary Policy Committee maintained the OPR at 3.25 at its meeting on 9th of July. And the Malaysian economy is expected to remain on a steady growth path, with domestic demand remaining as the key driver to growth. Headline inflation is expected to be higher due to domestic cost adjustments before moderating towards the second half of 2016. And the underlying inflation is, however, expected to remain contained amid stable domestic demand conditions. The Monetary Policy Committee recognizes that there are heightened risks to global growth and financial conditions, and these risks are being carefully monitored to assess their implications on the macroeconomic stability and prospects of the Malaysian economy. At the current level of the OPR, the stance of monetary policy continues to remain accommodative and supportive of the economic activity. Turning to the currency markets, all major and regional currencies, including the ringgit, have depreciated against the US dollar since September of 2014. This is a reflection of the persistent US dollar strength, which has appreciated by 22% against its trading partners since July 2014. And this is largely due to expectations of the interest rate normalization by the Federal Reserve Bank amidst the steady recovery in the US economy. The ringgit, however, faced more significant adjustments due in part to the lower global crude oil prices and domestic specific factors. Since July 2014, global crude oil prices have declined about 55%. As a result, currencies of oil and commodity exporting countries, including the ringgit, have experienced larger adjustments. And if you look at the chart that we have presented, these adjustments of the ringgit are somewhere in the middle, with South Africa being 15.7% and Russia by 41%, and the ringgit 21.1% is somewhere in the middle, together with Australia and New Zealand. For businesses, there are segments which may face higher costs due to their high import content, but there are also businesses who benefit from the depreciation with higher export earnings. In terms of household spending, the impact of higher import costs is expected to be modest and partially offset by the lower domestic fuel prices. Lower global commodity prices and low domestic fuel prices also cushion inflationary pressures. The movement of the ringgit partly reflects its role as an adjustment mechanism for the economy in response to the lower commodity prices. We know that when we have external developments, three adjustments can take place: prices, domestic prices, domestic demand, and the exchange rate. And it's very important that all three adjust rather than over-reliance on one to adjust. And therefore, we have the effects of it dispersed throughout the economy. So Bank Negara of Malaysia's role is to ensure the orderly functioning of the market to avoid disruptions to trade and business activities. And this is most important because we are a trading economy. Fluctuations in the level of the exchange rate and international reserves are expected outcomes in any managed float exchange rate regime. And the recent ringgit depreciation and decline in international reserves are expected during periods of capital outflows. During episodes of capital flow reversals, the ringgit exchange rate fluctuation functions as a shock absorber. And this is important. Exchange rate adjustments are part of the shock absorber. The principal role of building reserves as a buffer is such that it would be unwound to deal with the over-adjustment and overshooting of the exchange rate. And this is, of course, what we don't want to see, overshooting take place. During previous periods of capital outflows, we have seen reserves fall by a more significant magnitude than what we are seeing now. During the global financial crisis, when deleveraging was taking place, Malaysia's reserves fell to 87.7 billion US dollars before rising again to 136.3 billion US dollars in August of 2011. Therefore, we will set about again to rebuild our reserves. Currently, the level of international reserves remains ample to facilitate international transactions to take place without any disruption. Despite the capital outflows and depreciation in the ringgit, conditions in the domestic markets have remained orderly, and the bulk of the recent outflows have largely been driven by the non-residents' unwinding of the Bank Negara monetary notes. This is the BNN. Outflows through this instrument have ensured that the domestic financial markets are not significantly impacted, and this can be seen from the liquidity conditions both in the bond and equity market. In the bond market, the liquidity remains stable, as reflected by the monthly average trading in the government bond market, which remains above the 7-year average of 50 billion ringgit. Sustained demand from investors has also resulted in the bond yields to remain broadly on a declining trend. And between January to June this year, The 5-year MGS bond yield declined only by 17 basis points compared to the 5-year regional bond yields, which increased by 29 to 87 basis points. Despite the volatility in the equity market has increased, trading activities in the market remains above historical average amid continued support from domestic institutional investors. And net financing through the banking system and the PDS market expanded at a stable rate of 8.3% as at end June. And the growth of outstanding banking system loans remained relatively stable. In particular, the growth of outstanding loans to SMEs continued to be strong, growing at 17.2% as at end June. And the loans disbursed by the banking system to SMEs was also higher at 63.8 billion ringgit. And this is important because SMEs are an important sector in our economy. And the increase in funds raised in the capital market during the quarter, together with sustained loan disbursements, continued to provide support to economic activity. Domestic financial stability continues to be preserved despite all the volatility around us in the global and domestic financial markets during the quarter. Malaysian financial institutions remain sound and well capitalized with strong liquidity buffers, and this has supported favorable funding conditions for businesses and households. Financial market volatility eased but remain elevated, driven by developments in Greece and uncertainties on the timing of the normalization of monetary conditions in the United States. Sentiments in the domestic market improved in early July 2015 with the affirmation of Malaysia's credit ratings and revision in its outlook. Subsequent developments in China in these recent days have also generated some international volatility. The annual expansion of household debt sustained its moderating trend over 2 consecutive years now to 8.3%. And as you know, all the questions revolved around our domestic household debt prior to that, and we had implemented many macroprudential measures, and we are seeing the outcome of these measures now over the 2 consecutive years, and the trend at 8.3% is a more sustainable trend. This was driven by the slower growth in outstanding credit cards and balances and financing for the purchase of securities in particular. Growth in personal financing by non-bank lenders was also lower at 3.8%. And the annual growth in financing for the purchase of houses remains strong at 11.9%. So most of this slowing down of household borrowing is mainly for personal loans, but for houses, purchase of houses, it still remains strong at 11.9%. And households continue to be supported by stable income growth and employment conditions. Financial buffers are strong, with financial assets sustained in excess of 2 times of debt. And overall, the debt servicing capacity is further supported by improved loan affordability assessments by financial institutions. Aggregate leverage of businesses remains low and stable at 41.3%. Businesses continue to be well placed to service their debt, with interest coverage ratio improving further to 6.5 times. And this was led by domestic-oriented industries, particularly the construction and infrastructure and utilities industry, which benefited from lower input costs such as fuel and transportation expenses. And during the quarter, external borrowings increased by 11.1%, and however, this growth was mainly driven by one single large foreign currency bond issuance by a domestic conglomerate. And excluding this one issuance, external debt remained at much slower rate, increase at a much slower rate of 3% in the first quarter. On aggregate, developments in commodity prices and the ringgit exchange rates continue to have limited impact on the debt servicing capacity of most Malaysian businesses. Turning now to the banking sector. The banking sector's external exposure continued to expand during the quarter in line with their regional operations and trade activities. The bulk of such exposures are in Asia, which accounts for 61.4% of the total external assets and 65% of total external liabilities of banks. And during the first quarter, external assets of banks grew at a much faster pace relative to external liabilities, and this resulted in lower net external liability position of 110 billion ringgit as at end first quarter 2015. External liabilities are driven by deposit placements, custodian-related activities, and capital funds from parent entities. And the banking sector operations continue to be domestically funded in the form of ringgit deposits. And there's no reliance on external funds. So most of our bank's activities are based on their funding from deposits, that is, domestic deposits. The banking institution also have limited exposure to the current challenging economic and financial conditions in Greece. During the quarter, the total exposure to Europe accounts for only 9.5% of total external assets and 4% of total external liabilities, with the bulk of the total exposure mainly being from the EU 3 countries, that is UK, Germany, and France. Forward-looking indicators point towards a continued expansion in global and domestic economic activity. Global manufacturing production is weaker, but indicators remain expansionary, indicating continued growth. And trade activity in the coming quarters. For the domestic economy, average wages continue to grow amid increasing but still moderate inflation. Together with stable employment and continued access to financing, these indicators suggest fundamentals that will support private consumption activity. Additionally, planned investment by private sector remains positive as indicated by the forward-looking indicators. Going forward, global growth is projected to remain moderate. Growth improvements in the advanced economies are expected to remain modest. In the region, growth will be underpinned by domestic demand amid weak export performance. Downside risk remains as international financial markets continue to face volatility following increased concerns over developments in Europe and continued policy uncertainty in several major advanced economies. The Malaysian economy, however, has a diversified economic structure supported by strong fundamentals to withstand these risks and challenges. While the exchange rate depreciated may be unsettling, the impact on growth and inflation will be contained, mitigated by resilient domestic and external fundamentals. The orderly functioning of the financial markets will continue to preserve domestic financial stability and facilitate the necessary economic adjustments. Financial intermediation will continue to support our economy. In our assessment, the Malaysian economy is projected to remain resilient in the face of this challenging environment and is expected to continue to remain on a steady growth path. Thank you, and this concludes the presentation.